There is a growing sense that the global financial system is entering unfamiliar territory. For most people alive today, the dominance of the US dollar has felt permanent, almost natural, like gravity. Trade flows through it. Energy is priced in it. Nations store it as insurance. But history reminds us that no monetary system lasts forever. What we are witnessing now is not the sudden collapse of the dollar, but the slow formation of an alternative. One that challenges the assumptions the modern world has relied on for decades. Across Eurasia and the global south, a group of countries has been quietly laying the groundwork for a different way to settle trade, store value, and protect sovereignty. Brazil, Russia, India, China, and South Africa, collectively known as BR, are not bound together by ideology or geography, but by shared vulnerability. Each of them has felt, in different ways, the pressure that comes from living inside a dollar-centric world. And increasingly, they are asking the same question. What happens when the currency that governs global trade becomes a political weapon? For over half a century, the dollar has occupied a unique position. It is not merely a national currency, but the backbone of international finance. When countries want to trade oil, metals, or food, they do so in dollars. When they want stability, they hold us treasury bonds. This arrangement gives the United States an extraordinary advantage. It can borrow cheaply, run persistent deficits, and export inflation without facing the immediate consequences other nations would. But that privilege comes with resentment. Every interest rate hike by the Federal Reserve ripples outward. Every sanction imposed by Washington sends shockwaves through foreign economies that had no say in the decision. The BRICS nations together represent a massive share of humanity and production. Nearly 40% of the world's population lives within their borders, and their economic weight continues to grow. What began years ago as informal discussions about cooperation has gradually evolved into something more ambitious: the construction of parallel financial infrastructure that does not rely on Western-controlled systems. At the heart of that effort is a controversial idea, one that sounds almost anachronistic in a digital age: gold. Gold has always occupied a strange place in human history. It has no yield, no coupon, no promise attached to it. Yet for thousands of years, it has been trusted across civilizations that shared nothing else. Its appeal lies in its limitations. It cannot be created by policy decisions. It does not depend on elections or central bank credibility. It simply exists. For nations that have watched reserves frozen, payment systems shut down, and trade channels weaponized, that neutrality is deeply attractive. This is not theoretical. Over the past decade and a half, several BRICS countries have been accumulating gold at a pace not seen in generations. Russia dramatically increased its holdings after sanctions intensified in the mid-2010s. China has steadily expanded its reserves, while revealing only partial figures, leaving analysts to speculate that the true number is far higher. Even India, traditionally a large consumer of gold, rather than a strategic holder, has increased official reserves. These moves are not symbolic, they are strategic. The turning point came when financial sanctions crossed a psychological threshold, when hundreds of billions of dollars in sovereign reserves could be frozen with the push of a button. The assumption that reserve assets were untouchable collapsed. It became clear that holding wealth inside another country's financial system came with political strings attached. For many governments, this was not just a risk, but an existential vulnerability. From that moment, the idea of settling trade outside the dollar gained urgency. Not abandoning it entirely, but reducing exposure, using local currencies where possible, building payment rails that do not depend on Western intermediaries, and eventually, anchoring trust in something that cannot be digitally erased. Gold offered a solution, not as a return to the past, but as a foundation for a new hybrid system. What is being discussed is not a gold coin circulating in everyday commerce. The proposal, as it has been hinted at by officials and economists within BRICS, is far more subtle. A unit of account used primarily for cross-border trade. A digital settlement mechanism backed, directly or indirectly, by physical commodities, with gold playing the central role. This unit would not replace national currencies. It would sit above them, facilitating trade between states while bypassing the dollar. Technology makes this possible in ways previous generations could not achieve. Digital ledgers allow near-instant settlement. Tokenization allows claims on physical assets to be represented electronically. In theory, a shipment of oil could be exchanged for a digital unit tied to a fixed weight of gold, settled without touching Western banks, messaging systems, or correspondent networks. No SWIFT, no dollar clearing, no exposure to sanctions. Yet ambition does not erase complexity. A system like this faces enormous challenges. Gold-backed money imposes discipline, but it also imposes constraints. Supply cannot expand freely. Liquidity can tighten during crises. Growth can be restricted if demand outpaces reserves. These are not abstract concerns. They are the very reasons many countries abandoned gold-linked systems in the 20th century. There is also the question of trust within BRICS itself. These are not identical economies moving in lockstep. China is a manufacturing powerhouse and creditor. India runs persistent trade deficits. Russia depends heavily on energy exports. Brazil and South Africa are deeply tied to commodity cycles and global demand. Aligning such different structures under a shared monetary framework is not simple. This is why gold is so politically useful. It does not belong to any one member. It avoids the perception that one country's currency, particularly China's, would dominate the system. By anchoring trust in a neutral asset, BRICS can cooperate without surrendering sovereignty to a single leader. It is a workaround to internal rivalry as much as an external challenge to the dollar. Signs of preparation are already visible. Alternative payment systems are operational. Cross-border settlements in local currencies are increasing. Development banks within the BRICS ecosystem are issuing debt outside the dollar. Gold exchanges are expanding in Asia, reducing reliance on traditional Western pricing centers. These are not dramatic announcements. They are quiet construction projects. Critics often dismiss the idea as unrealistic, pointing to the failures of past gold standards, but the comparison is incomplete. This is not a rigid peg designed to govern domestic economies. It is a settlement layer for international trade. It does not need to replace the dollar to matter. Even a small diversion of global trade away from dollar settlement would have outsized consequences. The global financial system rests on confidence and habits. If 10% of world trade no longer requires dollars, demand for US debt changes, interest rates adjust, borrowing costs rise, the effects cascade. The dollar's dominance is not binary. It erodes gradually, through accumulation of alternatives, rather than sudden collapse. Energy markets are central to this story. The modern system of dollar dominance is inseparable from the pricing of oil. If major producers begin accepting non-dollar settlement for energy, the implications reach far beyond BRICS. Every country importing oil would suddenly have options, and options reduce dependency. At the same time, Western institutions are not standing still. Discussions of digital currencies, new settlement systems, and financial reforms are underway. But there is a philosophical divide. One model emphasizes control, surveillance, and centralized authority. The other emphasizes backing, neutrality, and insulation from political pressure. These are competing visions of what money should be in the 21st century. Around the world, central banks are voting with their balance sheets. Gold purchases have surged. Repatriation of reserves has accelerated. Even countries traditionally aligned with the West are quietly hedging. These are not ideological moves. They are insurance policies. So will a BRICS gold-backed currency emerge fully formed and transform the world overnight? Almost certainly not. What is far more likely is a gradual shift. Pilot programs, limited trade settlements, expansion as confidence grows. A slow migration toward a more fragmented, multipolar monetary landscape. History suggests this pattern is familiar. Reserve currencies do not disappear suddenly. They fade as alternatives gain credibility. The Dutch guilder, the British pound, and now potentially the dollar all followed this arc. Excessive debt, overreach, and the use of monetary power as a weapon tend to accelerate the process. In that sense, the BRICS initiative is not the cause of change, but the expression of it. A response to a system stretched to its limits. A signal that trust, once lost, is difficult to reclaim. Gold's return to prominence is less about nostalgia and more about necessity. For ordinary people, these shifts may seem distant, but their effects will be tangible. Prices, savings, and stability are all shaped by the monetary order that governs trade. A more fragmented system may be less predictable, but it may also be less dominated by a single set of interests. The most likely future is not one where the dollar vanishes, but one where it shares space, where multiple systems coexist, where gold, quietly and without fanfare, resumes its role as an anchor of trust, rather than a centerpiece of speculation. And if that happens, historians may look back on this period as the moment when the rules of global money began to change, not with a crash, but with a recalibration. What BRICS is building is still incomplete, still uncertain, and still contested. But the direction is clear. The world is preparing for a future in which monetary power is distributed rather than concentrated, and gold, ancient and unyielding, is once again at the center of that conversation. Hey everyone! If you enjoyed this video and want to stay updated with more insights on finance, make sure to subscribe to my channel, Financial Coin, and don't forget to hit that bell icon so you never miss our latest videos.